Chapter 13 is dealing with accounting for corporations. Last week, we talked about accounting for partnerships, and we talked about how we figure out how much income and loss would be distributed to each one of the different partners in a partnership. Well, this time, we're talking about the particulars that take place for corporations. So we'll identify the characteristics of corporations and their organization. Remember that a corporation is an entity that is created by law that is separate from its owners. And so that is something that is an important distinction, is that a corporation is separate from its owners. It has most of the rights and privileges as a person. Okay, but it's not a person, it is a separate entity. Owners of corporations are called stockholders or shareholders. So individuals, through different types of investment, they can purchase shares of stock in a company, and so they're shareholders. They own part of a company. So, for example, for me, I own shares in my Roth IRA retirement account. I own shares of ACTG, for example. So I own a very, very small piece of ACTG. Okay. Some corporations are public corporations. So, for example, like ACTG is, where anybody can own them. There's some that only certain people can purchase stock and are shareholders. Now, corporations are, which goes into the next point. Corporations can be separated into two types: a privately held or closely held corporation that does not offer its stock for public sale and usually has few stockholders. A publicly held company offers its stock for public sale and can have thousands or millions of shareholders. Public sale usually refers to the issuance of stock and then trading it on the stock exchange. Corporations represent an important type of organization. Their unique characteristics offer advantages and disadvantages. So first of all, some of the advantages of corporate form is that you have separate legal entity. A corporation operates with the same rights, duties, and responsibilities of a person. It takes actions through its agents, who are the officers and managers. Limited liability. The stockholders are not liable for corporate acts or debts. So remember, in a partnership, the partners are responsible, and they're the owners, and they're responsible for the debts and the acts of the business. Well, in the case of a corporation, the owners, in this case, stockholders, shareholders, they are not responsible for the debts and acts of the corporation. Transferability ownership rights. The transfer of shares from one shareholder to another usually has no direct effect on the operation, except when this causes a change in the directors who control or manage the corporation. So, for example, I told you that I own shares of AT&T. Well, I could sell those on the stock exchange, get that money pretty much probably instantly, and that would have no effect upon how that company is operating. Continuous life. A company's life, a corporation's life, is indefinite because it's not tied to the physical lives of its owners. So, for example, a sole proprietorship is the business that one person owns. Well, if that person passes away, then that business would no longer exist. Or in the example of, let's say, partners, and one of the partners should pass away, then the partnership would have to be reformed, another partner would have to be brought in, or there would have to be a change there. Corporations, they have an indefinite life. No mutual agency for stockholders. Stockholders that are not officers or directors of the business do not have the power to bind the corporation to contracts, referred to as a lack of mutual agency. So they can own the company, but they can't commit the company to anything, as long as they're not the officers or managers of the company. and an easier capital accumulation. Buying stock is attractive to investors because of these above advantages, which help corporations to accumulate large amounts of money. Now, some disadvantages to the corporate form of formation is that of government regulation. A corporation has to meet the requirements of a state's incorporation laws, and proprietorships and partnerships, they avoid many of these. So you have to submit your bylaws, you have to submit your articles of incorporation to the state, usually the Secretary of State, who then would grant the corporation. You don't have to do that to form a partnership or to form a sole proprietorship. And then corporate taxation. Corporations are subject to the same property and payroll taxes as the proprietorships or partnerships, but they also have additional taxes. The most burdensome are federal and state income taxes that together can be 40% or more of pre-tax income. Moreover, corporate income is usually taxed a second time as part of the stockholder's personal income when they receive cash dividends. And that would be called, it's an example of double taxation. So, for example, if the shareholders are also the directors of the company, when they get a dividend, it's being taxed. Or for me, as I say, owning shares individually of AT&T, my dividend would be taxed depending upon how it's held. But the corporation itself also is taxed. But whereas with a partnership or a sole proprietorship, those distributions are just taxed as ordinary income to their owners only. So the corporate organization and management. A corporation is created by obtaining a charter from a state. Organization expenses are the costs to organize a corporation. They could include legal fees, promoters' fees, and amounts paid to obtain the corporate charter. Ultimate control of a corporation rests with the stockholders who elect the board of directors. So that's one of the things. If you own stock, you'll get things in the mail, or they'll contact you to vote by proxy for various things. One of them would be to vote the directors for the corporation. In turn, the members of the board of directors hire the executive officers of the corporation. So the board of directors is then the one that chooses the executive officers for the corporation. Finally, officers of the corporation empower others to hire the needed employees. Employees, officers, and members of the board could also be owners of the corporation. The rights of stockholders. Stockholders have specific rights under the corporation's charter and general rights under state law. When a corporation has only one class of stock, it is identified as common stock. State laws vary, but common stockholders usually have the general right to vote at stockholder meetings or to register proxy votes. So you either could go to the meeting in person, or you would fill out the little proxy card and turn it in and return it by mail, or you could go on the website or whatever in order to register your votes by proxy. You could sell or otherwise dispose of your stock. You could sell the stock on the stock exchange, or maybe you could donate it to a nonprofit organization. You could purchase their proportional shares of any common stock later issued by the corporation. That is a presumptive right, protects stockholders' proportionate interest in a corporation. For example, a stockholder who owns 25% of the corporation's common stock has the first opportunity to purchase 25% of any new common stock. Receive the same dividend, if any, on each common share of the corporation. So if they give a dividend, they would have to give it the same amount in proportion to each for each share of common stock. So they couldn't give one person more for their shares. So each share gets a certain amount of a dividend. Okay. share in any assets remaining after creditors and preferred stockholders are paid when and if a corporation is liquidated. Each common share would receive the same amount. Stock certificates and transfer. Now, investors who buy a corporation's stock very seldom, but sometimes receive a stock certificate as proof of share ownership. Sometimes you can get these. Most often, it's all done electronically. So for example, what I have, as I say, I told you that I own shares of stock, for example, of AT&T and Aflac and some other companies. I hold them in a Roth IRA, which is a retirement account. So in that, it's all done electronically. So I've never received a stock certificate like what's shown on the screen, but sometimes you'll receive these. Many corporations, they issue only one certificate for each block of stock. So usually it's per 100 shares, you would get a certificate. They sell them in blocks of shares. A certificate, but it can be for any number of shares. On the screen, you see a stock certificate of the Green Bay Packers football team. A certificate shows the company name, and so in this case, Green Bay Packers, Inc. It shows the stockholder name, and so in this case, it would be more than likely to the bearer because it doesn't have a name filled in here. So that would be just whoever has the actual certificate, and it shows the number of shares. And so in this case, this is for one share of the Green Bay Packers Incorporated. Issuance of certificates, as I say, is becoming less common. A lot now, it's all done electronically, but you can still get them. Some people, like for example Disney, people will get them and get a share of Disney and then keep it for their kid, and their kid actually gets an actual stock certificate. Now, the basics of common stock: authorized, issued, and outstanding. So common stock, or capital stock, excuse me, is a phrase for any share issued to obtain capital, which is owner financing. This section introduces terminology and accounting for capital stock. So authorized stock is the number of shares that a corporation's charter allows it to sell. The number of authorized shares usually exceeds the number of shares that are actually issued and outstanding, often by a large amount. Now, selling or issuing stock is when a corporation can sell stock directly or indirectly. Issued stock is the total amount that has been sold to stockholders. Usually they'll sell it, they'll use an agent in order to sell it, and then it's usually sold on the stock exchange. Unless it's a privately held company, then they could sell it themselves. Now, outstanding stock refers to the issued stock that is held by stockholders. No formal journal entry is required for stock authorization. The corporation discloses the number of shares authorized in the equity section of its balance sheet or notes. So we see here in our example, the company has a total of 92,556,295 shares that were issued and outstanding. Notice that this common stock has what is called a par value of a penny. Low par values are normal in business. And we'll talk about what that means in just a minute. So there's a difference. The par value is not equal to the market value. So the par value stock is stock that is assigned a par value, which is an amount assigned per share by the corporation in its charter. There's no restriction on the assigned par value. In many states, the par value of a stock establishes the minimum legal capital, which refers to the least amount that the buyers of stock must contribute to the corporation or be subject to paying at a future date. For example, if a company issues 1,000 shares of $10 par value stock, the corporation's minimum legal capital in these states would be $10,000. And in the market value per share is the price at which the stock is bought and sold. Expected future earnings, dividends, growth, and other company and economic factors, as we know, influence market value. And I'll give you an example in just a minute of that. So traded stocks market values are available daily in newspapers such as the Wall Street Journal, and of course online. You can usually find that through Yahoo or Google, or you can find that through the brokerage firm that you're using. The current market value of previously issued shares, for example, the price of stock in trade between investors, does not impact the issuing corporation's stockholders' equity. So they're not going to be concerned about what their shares are currently being sold for. So for example, a lot of you might have heard today that Pfizer now is seeking approval now for a new COVID-19 vaccine. And so because of that, it was safe. They say it's like 90% effective against COVID, preventing COVID and everything. Well, because of that news, the market price of certain stocks increased in value. And also the value of certain companies' stock decreased in value. So for example, Zoom's stock, which is the program we're using now to conduct this teleconference, their shares value went down because people, of course, if we don't have COVID, there wouldn't be such a need for the teleconferencing. But other companies, like maybe some of the airlines, maybe some of other type of retailers and different type of businesses, their market price went up on that news because that was good news. So we know that other factors, the economy, dividends, future growth potential, all of that has an impact on the market value, but that isn't something that that individual business would be concerned about. So now the par value, no par value stock, or simply no par stock, is stock that's not assigned a par value per share by the corporate charter. Its advantage is that it can be issued at any price without the possibility of minimal legal capital deficiency. Now, stated value stock is no par stock to which the directors assign a stated value per share. Stated value per share becomes the minimum legal capital per share in this case. Stockholders' equity. Corporation's equity, also known as stockholders' equity, consists of paid-in or contributed capital. That would be the cash or the other assets that the corporation receives in exchange for stock. And in retained earnings, similar to what we've talked about before, but in this case, retained earnings is the cumulative net income or net loss that is not distributed as dividends. So dividends is when you distribute that net income or that net profit to your shareholders. How do we record the issuance of corporate stock? When common stock is issued at par value, we record both the assets received and the par value of stock issued. The entry to record Dylan's issuance of 30,000 shares of $10 values, par value for $300,000 cash on June 5th is shown. And so we see here that on June 5th, they received cash, the amount of $300,000 and debit, and then we would credit common stock with a $10 par value, $300,000. And so that would record that we issued 30,000 shares of $10 value, par value stock at par. So we sold it, the shares for $10, we received then a total of $300,000. Now, par value stock, it can be issued at par, it can be issued at a premium, which would be considered above par, or at a discount below par. In each case, stock can be exchanged for either cash or non-cash assets. So a premium on stock occurs when a corporation sells its stock for more than par or stated value. To illustrate, if Dylan's Snowboards issues its $10 per par value common stock at $12 per share, its stock is sold at $2 per share premium. The premium, known as paid-in capital in excess of par value, is reported as part of the equity. It is not revenue, and it's not listed on the income statement, so it'll be part of the equity. The entry to record Dylan's Snowboards issuance of 30,000 shares at $10 par value stock for $12 per share on June the 5th is shown. So we would see that we received cash. This time it would be in the amount of 360,000. So we had common stock $10 par value, so credit 300,000, and then we would also credit paid in capital in excess of par value common stock for 60,000 represents the $2 premium that we charged for the shares of stock. The paid in capital in excess of par value account is added to the par value of the stock in the equity section of the balance sheet as shown here. So remember, on the balance sheet, you would list your assets, you would list your liabilities, and you would list your stockholders' equity. So we see here stockholders' equity, and so we have common stock, $10 par value, 50,000 shares authorized, and 30,000 shares issued and outstanding. We only would list the amount that was issued and outstanding. So 30,000 times 10 is 300,000. And then we would list paid in capital in excess of par 60,000, which is the premium. Then we see here a note also, we had retained earnings of 65. So that would be our net income that we had from operations previous. And so then we see the total stockholders' equity then amount. Now, a no par value stock can be issued. With no par value stock, there wouldn't be an entry for paid in capital in excess of par. The total amount that was debited to cash is the same amount that is credited to common stock, no par value. So we see here that they issued 1,000 shares of no par value stock for $40 a share. So we see here cash 40,000 because that's what they received, and then common stock no par value of 40,000 credit. Now, stated value stock can also be issued. With stated value stock, the difference between the stated value and the selling price is credited or debited to the paid in capital in excess of stated value. So we see here in this example, if 1,000 shares of $40 stated value stock is issued for $50 a share, cash is debited 50 times 1,000 or 50,000 because that's how much cash we received as a business. Now, common stock $40 stated value is credited for 1,000 times 40 or 40,000. And then the paid in capital in excess of stated value is credited for 10,000. Now, a corporation can receive assets other than cash in exchange for its stock. It can also assume liabilities on the assets received, such as a mortgage on property received. The corporation records the assets received at their market values as of the date of the transaction. The stock given in exchange is recorded at its par value or stated value, with any excess recorded in the paid in capital in excess of par or stated value account. If no par stock is issued, the stock is recorded at the asset's market value. To illustrate, the entry to record receipt of land valued at $105,000 is shown, with the issuance of 4,000 shares of $20 par value common stock on June the 10th is shown on this slide. So we have land. So we received land in the amount of 105,000. So we would debit that. Then we would credit the common stock, which is $20 per par value is 80,000. And then we would credit the paid in capital in excess of par value common stock, 25,000, because we issued 4,000 shares at $20 par, and then anything above that is the paid in capital in excess of the par value. Now, a corporation sometimes gives shares of its stock to promoters in exchange for their work in organizing the corporation, which is recorded as organization expenses. So when you first organize the corporation, the entry to issue 600 shares of $15 par stock for 12,000 of organizing work is shown. So we have organization expenses, debit of $12,000, and we have credit for the amount common stock $15 par value for $9,000, because that would be 15 times 600 is 9,000, and then we have paid in capital in excess of par value of 3,000. Okay, so now we'll talk about how we record transactions involving cash dividends, stock dividends, and what happens with stock splits. Okay, the decision to pay dividends rests with the board of directors and involves more than evaluating the amounts of retained earnings in cash. The directors, for instance, must decide to keep may decide to keep cash to invest in the corporation's growth, to meet emergencies, to take advantage of unexpected opportunities, or to pay off debt. Alternatively, many corporations pay cash dividends to their shareholders at regular dates. These cash flows provide a return to investors and almost always affects the stock market value. And in order to pay a cash dividend, a corporation has to have a significant balance of retained earnings and also the cash necessary in order to pay the dividend. And so they may decide not to pay a dividend and use the retained earnings in order to further the business or to pay off debt, but usually they'll do it. And usually corporations, they have certain times that they do it, and usually they'll pay it usually on a quarterly basis. Now, dividend payment involves three important dates. First of all, the declaration, the record, and the payment. The date of declaration is the date the directors vote to declare and to pay a dividend. This creates a legal liability for the corporation to its stockholders. Now, the date of record is the future date for identifying those stockholders listed in the corporation's records to receive the dividend. Persons who own stock on the date of record are the ones that receive the dividends. Now, the date of payment is the date when a corporation makes payment. To illustrate, the entry to record a January 9th declaration of a $1 per share cash dividend by the directors of ZTEC Inc. with 5,000 outstanding shares is shown above. So the common dividend payable is a current liability. The date of record for ZTEC dividend is January the 22nd. So we see here that this is to record the liability. This is when they decide that they are going to pay a dividend. Is we have a debit to retained earnings in the amount of 5,000. We would credit common dividend payable 5,000. So that's the liability. So we credit the liability, and we would debit the retained earnings because we're taking that out of our retained earnings. Now, there is no formal journal entry that would be needed for the date of record. So we said that the date of record was the 22nd, so we would pay all the people that own the stock, the shares of stock that owned it on the 22nd, our dividend. We're not going to have to do any kind of a journal entry for that. Now, the February 1st date of payment requires an entry to record both the settlement of the liability and the reduction of the cash balance. So we would then go ahead and debit the common dividends payable 5,000, because that would then make that liability then zero, and then we would credit cash 5,000 to show the reduction in cash because we're the outflow of cash. Deficit and cash dividend. A corporation with a debit or abnormal balance of retained earnings has what's called a retained earnings deficit, which occurs when a company has cumulative losses and or pays more dividends than total earnings from current and prior years. A deficit reduces equity as shown on this slide. Most states prohibit a corporation with a deficit from paying a cash dividend to its stockholders. This legal restriction is designed to protect creditors by preventing distribution of assets to stockholders when a company may be in financial difficulty. Now, some states' laws allow cash dividends to be paid by returning a portion of the capital contributed by stockholders. This type of dividend is called a liquidating cash dividend, or simply a liquidating dividend, because it returns a part of the original investment back to stockholders. This requires a debit entry to one of the contributed capital accounts instead of the retained earnings on a declaration date. A stock dividend declared by the corporation's directors is a distribution of additional shares of the corporation's own stock to its shareholders without the receipt of any payment in return. So we could give either a cash dividend or we could give a stock dividend. So we could give people more shares of stock. Stock dividends and cash dividends are different. A stock dividend does not reduce assets and equity, but instead transfers a portion of equity from retained earnings to contributed capital. Stock dividends exist for at least two reasons. First, directors use stock dividends to keep the market price of the stock affordable. When a corporation has a stock dividend, it increases the number of outstanding shares and it lowers the per share stock price. Another reason for a stock dividend is to show management's confidence that a company is doing well and will continue to do so. A stock dividend transfers part of retained earnings to contributed capital accounts, sometimes described as capitalizing retained earnings. Accounting for a stock dividend depends on whether it is a small or large stock dividend. A small stock dividend is a distribution of 25% or less of previously outstanding shares. It is recorded by capitalizing retained earnings for an amount equal to the market value of the shares to be distributed. A large stock dividend is a distribution of more than 25% of previous outstanding shares. A large stock dividend is recorded by capitalizing retained earnings for the minimum amount required by state law governing the corporation. Most states require capitalizing return earnings equal to par or stated value of the stock. Assume that Quest's directors declare a 10% stock dividend on December 31st. This stock dividend of 1,000 shares, computed as 10% of its 10,000 outstanding shares, is to be distributed on January the 20th to the stockholders of record on January the 15th. Since the market price of Quest stock on December 31st is $15 per share, this small stock dividend declaration is recorded as shown. The $10,000 credit to the declaration entry equals the par value of the shares and is recorded in common stock dividend distributable, an equity account. Its balance exists only until the shares are actually issued. The $5,000 credit equals the amount by which market value exceeds par value. This amount increases the paid-in capital in excess of par value account in anticipation of the issuance of shares. In general, the balance sheet changes in three ways when a stock dividend is declared. First, the amount of equity attributed to common stock increases. For Quest, from 100,000 to 110,000 for 1,000 additional declared shares. Second, paid-in capital in excess of par increases by the excess of market value over par value for the declared shares. Third, retained earnings decreases, reflecting the transfer of amounts to both common stock and paid-in capital in excess of par. The impact on stockholders' equity of Quest is shown in Exhibit 13.6 when its 10% stock dividend is declared on December 31st. The combined effect of these stock dividend entries is to transfer or capitalize 15,000 of retained earnings to paid-in capital accounts using right side column of Exhibit 11.6. I think they mean 13.6. The amount of capitalized capital earnings equals the market value of the 1,000 issued shares, $15 by 1,000 shares. A stock dividend, remember, has no effect on the ownership percentage of the individual stockholders. No entry is made on the date of record for the stock dividend. And so then on January the 20th, the date of payment, Quest distributes the new shares to stockholders and records this entry as shown. This entry is reflected in the issuance column in the previous slide. Reporting of large stock dividends. A corporation capitalizes retained earnings equal to the minimum amount required by state law for the large stock dividend. For most states, this amount is the par or stated value of the newly issued shares. To illustrate, suppose that Quest's board declares a stock dividend of 30% instead of 10% on December 31st. Since the dividend is more than 25%, it is treated as a large stock dividend. Thus, the par value of the 3,000 computed as 10,000 outstanding shares multiplied by 30% dividend shares is capitalized at the date of the declaration with the entry that you see here. This transaction decreases retained earnings and increases attributed capital by 30,000. On the date of payment, the company debits common stock dividend distributable and then would credit the common stock for $30,000. The effects from a large stock dividend on the balance sheet account are similar to those of a small stock dividend, except for the absence of any effect of paid-in capital in excess of par. Now, stock splits. This is something that happens sometimes. A stock split is a distribution of additional shares of stock to stockholders according to their percentage ownership. When a stock split occurs, the corporation calls in its outstanding shares and issues more than one new share in exchange for each old share. Splits can be done in any ratio. To illustrate, CompTech has 100,000 outstanding shares of $20 par value common stock with a current market value of $88 per share. A 2-for-1 stock split cuts par value in half as it replaces 100 shares of $20 par value stock with 200,000 shares of $10 par value stock. Market value would then be reduced from $88 per share to about $44 per share. The split does not affect any equity amounts that are reported on the balance sheet or any individual stockholder's percentage ownership. Both the paid-in capital and the retained earnings accounts are unchanged by a split and no journal entry is made. The only effect on the accounts is a change in the stock amount, stock account description. So CompTech's 2-for-1 split of its $20 per par value stock means that after the split, it's changing its stock account title to common stock at $10 par value instead of saying common stock 20. This stock description on a balance sheet also changes to reflect the additional authorized, issued, and outstanding shares and the new par value. A stock split is the distribution of additional shares of stock to stockholders according to their percentage ownership. In many respects, a 100% stock dividend and a 2-for-1 stock split result in similar impacts in the market price of the share outstanding. The stock split usually requires more administration task to call in and reissue stock certificates. However, sometimes corporations do not reissue certificates in stock split, saving them some administrative costs. Cash dividends will decrease total assets cash and decrease total stockholders' equity where retained earnings is decreased. Small stock dividends will increase both common stock and paid-in capital in excess of par accounts when retained earnings will be decreased. Large stock dividends will increase common stock and decrease retained earnings. Stock splits leave all the accounts unchanged, thus no journal entry is required. Explain the characteristics of and distribute dividends between common and preferred stock. So far we've been talking about common stock, but there is also a type of stock that is called preferred stock. Now, preferred stock has special rights that give it priority or a senior status over common stock in one or more areas. Special rights typically include a preference of receiving dividends and in the liquidation of assets. That means that they would receive dividends first, or they would receive, when the company liquidates, they would be closer in line to receive the proceeds of a liquidation. Preferred stock has the rights of common stock unless the corporate charter nullifies them. And so, for example, most preferred stock does not confer the right to vote. So preferred stock, they give up the right to vote, but they get some additional things that common stock doesn't have. So the graph on this slide shows that preferred stock is issued at about by about one-fourth of corporations. All corporations issue common stock. Preferred stock usually carries preference for dividends, meaning that preferred stockholders are allocated their dividends before any dividends are allocated to common stockholders. The dividends allocated to preferred stockholders are usually expressed as a dollar amount per share or a percentage applied to par value. A preference for dividends does not ensure dividends. If the director does not declare a dividend, neither the preferred nor the common shareholders receive one. Most preferred stocks carry a cumulative dividend right. Cumulative preferred stock gives its owners a right to be paid both the current and all prior periods unpaid dividends before any dividend is paid to common stockholders. When preferred stock is cumulative and the directors either do not declare a dividend to preferred shareholders or declare one that does not cover the total amount of cumulative dividend, the unpaid dividend amount is called dividend in arrears. Accumulation of dividend in arrears on cumulative preferred stock does not guarantee they will be paid. Non-cumulative preferred stock offers no right to prior periods unpaid dividends if they are not declared in those prior periods. This slide shows the allocation of dividends for those 2 years. Allocation of year 2019 dividend depends on whether the preferred stock is non-cumulative or cumulative. With non-cumulative preferred, the preferred stockholders never receive the $4,000 skipped in 2018. If the preferred stock is cumulative, the $4,000 in arrears is paid in 19 before any other dividends are paid. A liability for the dividend does not exist until the directors declare a dividend. If a preferred dividend date passes and the corporation's board fails to declare the dividend on its cumulative preferred stock, the dividend in arrears is not a liability. The full disclosure principle requires the corporation to report, usually in a note, the amount of preferred dividends in arrears as of the balance sheet date. To illustrate, the difference between cumulative and non-cumulative preferred stock, assuming that a corporation's outstanding stock includes 1,000 shares of $100 par 9% preferred stock yielding $9,000 per year. So that would be 1,000 shares multiplied by $100 par multiplied by 9% in potential dividends, and 4,000 shares of $50 par value common stock. During 18, the first year of operations, the directors declare cash dividends of $5,000. In year 19, they declare cash dividends of $42,000. For year 2019, under the cumulative method, preferred will receive $4,000 for dividends in arrears that were from 18, plus the current year's dividends of $9,000 for a total of $13,000. Common will receive $29,000. Total dividend for 19 is $42,000, $13,000 preferred, plus the $29,000 for common. Now, for year 2019, under the non-cumulative method, preferred would receive 0 for 18 since there was no dividend in arrears. they will receive the normal $9,000 dividend for 18. Common then will receive the remainder. 42,000 minus 9 is 33,000. Now, participating and non-participating stock. Non-participating preferred stock has a feature that limits dividends per year. Once preferred stockholders receive this amount, the common shareholders receive any and all additional dividends. Participating preferred stock has a feature allowing preferred stockholders to share with common stockholders in any dividend paid in excess of the percent or dollar amount stated on the preferred stock. This participation feature does not apply until common stockholders receive dividends equal to the preferred stock's dividend percent. Many corporations are authorized to issue participating preferred stock, but rarely do, and most managers never expect to issue it. Preferred stock is issued for several reasons, including to raise money without giving up control, to boost the return earnings earned by common stockholders, and to appeal to some investors who believe that the corporation's common stock is too risky or that the expected return on common stock is too low. So now to record the purchase and sales of treasury stock. Corporations buy back shares of their own stock for several reasons: to use their shares to acquire another corporation, to avoid a takeover of the company, to give them to employees as compensation, and to maintain a strong market for their stock or to show management confidence in the current price. A corporation's reacquired shares are called treasury stock, which is similar to unissued stock in several ways. First, neither treasury stock nor unissued stock is an asset, and neither receive cash dividends or stock dividends, and neither allows the exercise of voting rights. This graph illustrates the majority of corporations have some treasury stock. Cyber, so the purchasing of treasury stock. Cyber purchases 1,000 of its own shares for 11,500 on May the 1st, which is recorded as shown. And so we have a debit to treasury stock common of 11,500, and then we credit cash the amount of 11,500. This entry reduces equity through the debit of the treasury stock account, which is a contra equity account. And then selling treasury stock at cost. If treasury stock is reissued at cost, the entry is the reverse of the one that was made to record the purchase. For instance, if on May the 21st, Cyber issues 100 of the treasury shares purchased on May the 1st at the same $11.50 per share cost, the entry would be shown. We would debit cash the amount of $1,150, and then we would credit the treasury stock common for $1,150, because that would then show then that we issued the stock or sold it. Now, selling treasury stock above cost. If treasury stock is sold for more than cost, the amount received in excess of cost is credited to the paid-in capital treasury stock account. This account is reported as a separate item in the stockholders' equity section. No gain is ever reported from the sale of treasury stock. To illustrate, if Cyber receives $12 cash per share for 400 treasury shares costing $11.50 per share on June 3rd, the entry is shown. So we have a debit to cash, the amount of $4,800. Then we have a credit to treasury stock common for $4,600. And then we have a credit to the paid-in capital treasury stock for $200. And then selling treasury stock below cost. When treasury stock is sold below cost, the entry to record the sale depends on whether the paid-in capital treasury stock account has a credit balance. If it has a zero balance, the excess of cost over the sales price is debited to retained earnings. If the paid-in capital treasury stock account has a credit balance, it is debited for the excess of the cost over the selling price, but not to exceed the balance of this account. When a credit balance is in this paid-in capital account is eliminated, any remaining difference between the cost and selling price is debited to retained earnings. To illustrate, if Cyber sells its remaining 500 shares of treasury stock at $10 par value on July the 10th, equity is reduced by $750. So 500 shares multiply by $1.50 per share cost, excess of cost over selling price is shown here. So we would debit cash the amount of $5,000 because that's what we're receiving. We would debit the paid-in capital treasury stock 200. We would debit the retained earnings 6,500. We would credit treasury stock common 5750. Then we will explain the items that are reported in the retained earnings. Retained earnings generally consists of cumulative net income minus any net losses and dividends declared. Retained earnings does not imply that a certain amount of cash or other assets is available to pay stockholders. The term restricted retained earnings refers to both statutory and contractual restrictions. A common statutory or legal restriction is to limit treasury stock purchases to the amount of retained earnings. A common contractual restriction involves loan agreements that restrict paying dividends beyond a specified amount or percentage of retained earnings. Restrictions are usually described in the notes. The term appropriated retained earnings refers to a voluntary transfer of amounts from the retained earnings account to the appropriated retained earning account to inform users of special activities that require funds. Prior period adjustments are corrections of material errors in prior period financial statements. These errors could include math mistakes, improper accounting, and missed facts. Prior period adjustments are reported in the statement of retained earnings net of any income tax effects. Prior period adjustments result in changing the beginning balance of retained earnings for events occurring prior to the earliest period reported in the current set of financial statements. To illustrate, assume that ComUS made an error 2 years ago in a journal entry for the purchase of land by incorrectly debiting an expense account. When this is discovered in the current year, the statement of retained earnings include a prior period adjustment as shown on this slide. This exhibit also shows the usual format for the statement of retained earnings. A statement of stockholders' equity lists the beginning and ending balances of key equity accounts and describes the changes that occur during the period. The usual format is to provide a column for each component of equity and use the rows to describe events occurring in a period. This slide shows a condensed statement for Apple. And so now we'll learn how to compute earnings per share and describe its use. So the income statement reports earnings per share, also called EPS or net income per share, which is the amount of income earned per share of a company's outstanding common stock. The basic earnings per share formula is shown. When a company has no preferred stock, the preferred dividends are zero. The weighted average common shares outstanding is measured over the income reporting period. Its computation is explained in advanced courses. So the basic earnings per share is the net income minus preferred dividends over the weighted average common shares outstanding. Then we'll learn how to compute price earnings ratio and to describe its use in analysis. A comparison of a company's EPS and its market value per share reveals information on market expectations. This comparison is traditionally made using the price earnings, or as you've probably heard called a PE ratio, expressed as price earnings, price to earnings, or PE. Some analysts interpret this ratio as what price the market is willing to pay for a company's current earnings stream. Price earnings ratios can differ across companies that have similar earnings because of either higher or lower expectations of future earnings. The price earnings ratio is defined on this slide. So the price earnings ratio is the market value or price per share divided by the earnings per share. And then we'll compute the dividend yield and explain its use and analysis. Investors buy shares of a company's stock in anticipation of receiving a return from either or both the cash dividends and stock price increases. Stocks that pay large dividends on a regular basis, called income stocks, are attractive to investors who want recurring cash flows from their investment. In contrast, some stocks pay little or no dividends but are still attractive to investors because of their expected stock price increases. One way to help identify whether a stock is an income stock or a growth stock is to analyze its dividend yield. Dividend yield, which is defined in this slide, shows the annual amount of cash dividends distributed to common shares relative to their market value. So the dividend yield is the annual cash dividends per share divided by the market value per share. Then we'll compute the book value and explain its use and analysis. The book value per common share reflects the amount of stockholders' equity applicable to common shares on a per share basis. It is calculated as stockholders' equity applicable to common shares divided by the number of common shares outstanding. And so in this example, LTD's equity is shown. This year's dividends on preferred stock have been paid, but 2 years of preferred dividends are in arrears. LTD's book value computation is shown. Equity allocated to any preferred shares is removed before the book value on common shares is computed. And so we see that the book value per common share is the stockholders' equity applicable to common shares divided by the number of common shares that are outstanding.